Welcome back to Click Capital, everybody, and I've got a really cool video for you today where I'm going to be talking about when to sell a stock, and I'm going to share with you my unique strategy that I can almost guarantee you've never seen anything like it. I think you're going to find it really interesting, and this is a strategy I'll be using for my new stock pick service and $1 Million Challenge that I just opened the doors to yesterday. Had a few members reach out to me, along with a few others that are interested in hopping on board, wanting to know a bit more about my investing strategy and exactly how I know when to sell a stock. So I thought I'd make this video, and even though in the members area, I do have a detailed description of my strategy and what to expect, I thought it'd be a good idea to make this video and dive a bit deeper into the topic of how I know when to sell a stock. And so stick with me all the way through to the end. I'm going to show you examples of how I do it, along with some backtest results and some other cool stuff as well. First off, a bit of what we'll cover today. I'm going to show you the benefits of trend following for exiting. I'm going to show you the different types of exit strategies, including my new type that you've probably never seen before. And like I said, I'm going to show you how I'll be doing it for my new stock pick service, as a lot of you guys are interested to know. First off, let's just quickly talk about when to sell a stock, and it can actually be quite stressful for a lot of people, and that's because they're guessing. And it can be both stressful when you've got a stock going down and up. For example, you might buy a stock and it goes up 30-40% and you're looking at that dollar amount. You think, oh, that's great. I might wait till it goes up 50%, then I'll sell it. Then all of a sudden it starts going down. You see your open profits start to evaporate. And since nowadays it's so easy to sell, you just open up the app on your phone and you end up clicking that sell button and you ended up getting shaken out early. So you really need to remove the guessing and emotions from your decisions, because in order to be a successful investor, you have to practice discipline every day and not make financial decisions based on news headlines, dollar or percentage amounts, guessing, or emotions in the heat of the moment. And so to avoid that, you need clear exit strategies. Having well-defined exit strategies that are mostly systematic is the best way to avoid making bad decisions and remove the stress from your investing. Let simple and proven rules guide you. And out of all the strategies that I teach, long-term investing, there's nothing wrong with buy and hold, fair value targets and all that, but my favorite by far is definitely trend following. It's what I consider the most robust and classical way of trading, and it just works because markets will always trend, and they can quite often go further for longer than we naturally think. And so trend following allows you to capture these massive trends without having to guess when a market is top. Because if you look for it, it's always easy to find a reason to sell a stock or even be out of the market. Nothing is ever always perfect. And if you wait for everything to be perfect, you'll end up getting in or out way too late. And practicing trend following as a strategy works because it helps to keep you systematic. Like many things in life, having simple principles works great in investing too. There's only so many ways to measure price going up and down, so don't overcomplicate it. However, it will always give back some open profits, because trend following is far from perfect. In fact, it's quite chaotic and messy to practice. You will never sell the top, and you will always give back a good chunk of open profits when selling. And a lot of people who try trend following struggle with that, and they try and get too clever and not giving back profits. But that's just the reality of any trend following strategy. The benefit of that, it will keep you out of downtrending assets and rotate your capital back into uptrending assets instead, because staying in the game is always the first objective in investing. And so let me just quickly share with you some academic research that proves trend following works over long periods of time and on different asset classes, especially long only on stocks. And so in this research paper here, they call trend following a persistent market anomaly. And they did a really deep backtest over many different financial assets, currencies, commodities, bonds, and stock indices from countries all around the world. In fact, they ran the data over 200 years. And their conclusion was a simple trend following strategy applied to a pool of liquid futures delivers a system with a modest, though highly significant, positive Sharpe ratio. The strategy's stability across both asset classes and time periods adds to the significance of the result. Here's another one, 2 centuries of trend following. And just looking at the research paper abstract, they found the trend following effect across all asset classes to be very stable, and the existence of trends as one of the most statistically significant anomalies in financial markets. And that's something you'll find in financial markets over any asset class and time period, is there are trends in the prices of assets not explained by randomness. For example, if you generated 1,000 random numbers, you would find some random trends in there. However, financial markets have more trendiness than randomness would suggest, and it's kind of a really persistent effect in financial markets. Here's another one from Quantpedia, 100 years of multi-asset trend following, and they also found abnormal return in the data just from using really simple trend following rules. And so most of the trend following industry manage futures. They do it across futures markets, both long and short. But what about what I'm doing? Long only in stocks. Does trend following work on stocks? Well, that too has plenty of research and evidence to back up that it does really well, just like futures as well. Here's one study that covered over 24,000 stocks, including delisted companies, to account for survivorship bias. That is, companies that have gone bankrupt. If you just do a back test on a portfolio of current securities, you don't get to see all the stocks that were actually on the market years and years ago. So they accounted for delisted companies. And again, a really simple, systematic trend following strategy. The entry signal was when a stock just closed at its all-time highest close. Then it just bought the stock the next day. And for the exit, they just used a simple ATR trailing stop, like a volatility stop, which is basically 10 times the average daily range from the most recent high. There's kind of a look at how it works. And on another stock as well. Pretty much all trailing stops look like that, whether it's percentage, ATR, volatility, or whatever. As the stock moves higher, the trailing stop just follows it up. And there's a look at the results distribution of this system. And what you'll find with trend following is the outliers, not explained by a random distribution. That is, big winning trades occur a lot more often than what randomness would suggest. As like I said, financial markets have a tendency to trend, and sometimes they can produce really big trends that go a lot further than we think. However, most of the trades will be small wins and small losses. And so basically they concluded the evidence suggests trend following works well on stocks, buying stocks at new all-time highs, following them with a trailing stop would have yielded a significant return on average. The evidence also suggests that such trading would not have resulted in significant tax burdens relative to buy and hold investing, shows the potential for diversification, and those trade results distributions shows a significant right skew, indicating that the large outlier trades would have been concentrated among winning trades rather than losing trades. Quantpedia again found the same thing. For a simple trend following strategy on stocks, just entering at an all-time high, they tested an average true range trailing stop as well, and their backtest showed average annual performance of 19.3%, pretty good drawdown too at 20%, and a very high and healthy Sharpe ratio, 1.24. For those of you who don't know, Sharpe ratio is a measure of risk-adjusted returns. Looks at volatility versus returns, basically. So that's trend following price, but what you may not have heard of is fundamental momentum. Momentum in a company's earning has also been proven to deliver abnormal returns, especially companies that surprise on their earnings results, along with analysts increasing their earnings expectations for a stock. That's a big driver of stock price returns. There's also what's known as post-earnings announcement drift, or PEAD. Again, stocks that post really good earnings beat with uptrending earnings tend to deliver better returns than average, and that can be harnessed as part of a trading system. And also momentum and revenue, a company's sales. And when you combine price, earnings, and revenue momentum, this study found combining a momentum strategy utilizing all three measures can yield a monthly return as high as 1.57%. That's a lot higher than what the S&P 500 averages. So again, you don't have to overcomplicate it. Like I said, there's only so many ways to measure a stock going up and down. And I've seen and done plenty of backtests myself that show a simple percentage-based trailing stop can work really well, mostly between 20 and 40%. Some people try and get too clever and make really tight trailing stops, but I can tell you, in trend following, the looser the better. You really need to give assets wiggle room and time to develop big trends, and sure, you'll always give back some of that open profit off the highs. However, there's just no other way to make 100, 200, 300% on a stock unless you really give it some breathing room. And there's nothing wrong with using an average true range volatility based trailing stop either. However, I'm going to show you some new types of trailing stops, like I said at the start of this video, you've probably never seen before. It's a new area of trend following in stocks, not just looking at the technicals, but also company fundamentals like revenue, cash flow, and earnings estimates. And so I'm about to show you the exit strategy I'll be using for my new stock pick service, where I'll be combining technicals and fundamentals to determine when to get out. First of all, let me just make it very clear that price momentum reigns supreme. That's the number one most important. However, it's not the only thing that matters. I've found combining technicals and fundamentals give a much more holistic picture of the stock and what a good trend is. And my approach, like in pretty much all of my investing strategies, is mostly systematic with some discretion. I believe in the 80-20 rule, being 80% systematic and 20% discretionary. And like my old banking boss used to tell me, you need to have freedom within boundaries. It's kind of something that's stuck with me all these years, and I still practice to this day. So let's dive into the charts, and I'm going to show you my exit strategy that I'll be using for my new stock pick service. So first off, before I get into the exit strategy, let me just quickly touch on how I decide what stocks to buy. So first we start with a top-down analysis, macro analysis, what's the current market environment, what are the strongest and weakest markets out there. So that's step one. Then I move on to some quantitative screening, sorting through over 4,000 liquid stocks, ETFs, ADRs, and REITs to get a short list. Then I'll run some inter-portfolio correlation, IPC tests on my final short list of stocks, taking into consideration the current portfolio and always wanting to keep that diversified. Next, I use my custom fundamental indicators along with some qualitative analysis to decide on what stock to buy every Monday, as I'm buying one new stock every week with dollar cost averaging. Then once I've decided what stock to buy, I use a number of trailing indicators to help me decide when to get out. The first being a modified version of my custom trend candles indicator. And that's basically my own unique strategy of trend following I've designed for long only stocks, and I've extensively backtested it and proved its robustness across many different assets and over long periods of time as well, like I'm about to show you. And I actually run it on a 3-day chart. I've found the daily chart is a bit too noisy, as prices can whipsaw a lot in the short term. And even though weekly charts can work really well, I found the average trades are open a bit too long for me. And so I found the nice middle ground between daily and weekly is to use a 3-day chart. So every candle you see here represents 3 days of trading. And so this is my own custom indicator, and I'll show you some back tests on it. The first being on the oldest stock index in the world, the Dow Jones Industrial Index. Been around since the late 1800s. And if I just come and click on Strategy Tester, what you're looking at here is a 125-year-old backtest that buys the Dow Jones Industrial when the candles go green and sells it when the candles go red. So it's a long-only trend-following strategy. And like I said, it's got trade results going all the way back to 1896. And you can see the percent of trades that are profitable, just under half. So that's typical of a trend-following strategy. If a trend-following strategy had a win rate above 60%, it's not really doing it right. In fact, a lot of big trend-following hedge funds out there, some of their win rates are as low as 30%. They've really got loose trailing stops. Most of their trades are closed for a small loss, and every now and then they'll capture a monster trend. So that shows the robustness of my strategy on the Dow Jones Industrial Index. I'll show you a bunch of other assets as well. There's S&P 500 ETF SPY, actually came in with a really good high win rate. There's the NASDAQ Qs, the Russell 2000. There's the results on Apple. And it's not just those big mega cap tech stocks and the stock indices that have been performing well for quite a while now. Even on stocks that haven't done so well in the last 20 years, like Intel. In the long term, my strategy is still profitable. General Electric, which stock price peaked out 24 years ago back in 2000. My strategy still held up over the long term. And not just stocks either. Here's my strategy with the exact same parameters and settings on gold. Profitable over the long term, 48% win rate. There it is on the Aussie dollar. There it is on treasury bonds. And of course, you know it's done really well on Bitcoin. The point is I've tested it extensively and proved its robustness, working on a large amount of assets over a long period of time. It's really not a complicated strategy. And like I said, I've just tweaked my trend candles indicator, made a few slight changes to run it on stocks long only. But in addition to my modified trend candles indicator that I run on the 3-day chart, I also run some trailing stops on some fundamental data, namely revenue, free cash flow, and EPS estimates. That's what Wall Street analysts expect the company to make next quarter. And for revenue and free cash flow, I'm using TTM, which means trailing 12 months. So the data here is in the green line. And if you've got TradingView, when you add these financial indicators to your chart, you can come up here, click on More, click on Add Indicator, type in SMA, then you can add a moving average to the fundamental data on your chart. And that's what this red line is here. I've got SMAs on all my fundamental indicators. For revenue and free cash flow, the length of the SMA is 6, which means it's averaging the results from the past 6 quarters, a year and a half, which I found is a pretty good number to use. And so basically what I like to see, and what you'll find with all of my current open stock picks, got 4 open so far, just about to open my 5th stock pick that I've already sent to paid members. You'll see that price and all the fundamentals, revenue, free cash flow, and EPS estimates are uptrending and are above their 6-quarter moving averages. Another thing I watch, again based on evidence and research, is earnings results, which you can see here on the chart. Every quarter we get the earnings. If it's green, that means the company's beat expectations. If it's red, it means it's coming lower than expectations. So what we want to see is positive earnings surprises, like I showed you in that research. Stocks that consistently beat on earnings estimates tend to do well. And so again, you'll see in all my positions, recent earnings have come in better than expectations. So there's 5 types of momentum I like to see. Number 1, and most importantly, price momentum, earnings surprise momentum, trailing 12 months revenue momentum, trailing 12 months free cash flow momentum, and quarterly EPS momentum as well. Now, all 5 of those things don't have to be uptrending for me to buy a stock. Most of my picks, most of them will be uptrending. And again, not all of them have to be downtrending for me to exit a stock either. However, these are the things I'm using to decide when to get out of position. And since I haven't sold any positions yet, let me just give you an example on 4 really good performing stocks this last year or so. And I know these are outliers, but I want to use them as an example to show you how I'll be treating outliers, because this is really what we're hunting for when we're trend following. And like I said, this is where the bulk of the profits is going to come. So we'll start with one of the best stocks in the market this last year, Nvidia, one we're all really familiar with. We can see it went into a downtrend in 2022, and let's just zoom in a bit, and we can see here in their last quarter for 2022 they did miss by a bit. Price momentum went green in December. However, we only had one fundamental indicator uptrending, that was revenue. We had earnings miss along with downtrending free cash flow and EPS estimates. So let's track it forward. The next earnings, they had a pretty good beat, 8%. Price is still trending up. However, we've still got the other three fundamental indicators downtrending. Fast forward to this earning, monster beat, 18%. We now got EPS estimates uptrending. So that's 3 out of 5 indicators uptrending. One could have taken a position there. But once we got to the start of August, we had all 5 indicators uptrending. Price is clearly uptrending. EPS beat, revenue, free cash flow, and EPS estimates. Everything's uptrending. So that's green lights across the board. One could have got in at $46 a share. And let's track it forward. Earnings beat, fundamental indicators still uptrending. Another earnings beat, yet another earnings beat, and once again, the recent quarter, everything's still uptrending. So using this strategy, there's no reason to exit Nvidia right here, as both price, earnings results, revenue, cash flow, and EPS estimates are all uptrending. And I know in a lot of measures, Nvidia is not cheap, but like I said, markets can do crazy things. Who knows? Nvidia could keep going to $200 a share, or we could have already seen the top. No one really knows. And that's why trend following takes the stress out of investing, because it just keeps you in a position for as long as it wants to keep going up. Because stocks can trade on a PE of 100, 200. There's no hard limit on how high they can go. So that was a pretty easy one. Let's move on to another good performing stock, Wingstop. And everything's been uptrending in this stock since late last year. However, here comes to the part where I can use discretion. Because back here in July last year, my trend candles turned red. And sometimes it can be a bit aggressive, just the way I've designed it. But its most recent earnings result was a pretty good beat, 30%. All the other 3 fundamental indicators clearly uptrending, and the market had actually pulled back in that period of time as well. And from its most recent high, it only come off about 24%, which is not much at all. In backtests, I found the sweet spot with stocks is around 30-35%, but that's not exactly how my trend candles work. But like I said, price momentum reigns supreme. So in this example here, I may have continued to hold Wingstop even though the candles went red, because its most recent earnings beat was really good. The 3 other fundamental indicators are strongly uptrending, and this pullback is explained by market weakness. If the market was hitting new all-time highs and this stock was pulling back, that's a different story. What's also a different story is if the stock had fell by more than 35-40%, regardless of the fundamentals, market or whatever, I would have exited. It could be very rare that I'd be holding a stock more than 40% off highs. You don't really want to let it go more than 50% off highs, unless it was a super volatile stock on a massive ride, but not for Wingstop. Again, that's where some discretion and market knowledge and awareness can come into play in your decisions. But like I said, 80% you want to be systematic, 20% discretionary, and that's an example where I may have continued to hold. Stocks performing really well, earnings beat after earnings beat, fundamentals uptrending. The market was just pulling back, and that explains its weakness. And I know I'm talking in hindsight here, but I'm just trying to give an explanation of my process and thinking. So I would have kept this position open, and in fact, I'd still be in it today because everything's uptrending. The price, earnings beats, revenue, cash flow, and estimates. It's all pointing up. However, once we get price coming off, and like I said, if it did come off by more than 30% or so, especially if we had an earnings miss, and 1 or 2 of the other fundamental indicators started downtrending, that's when I'd probably pull the trigger and get out. But like I said, just a bit of discretion and a bit of freedom within boundaries. Similar story for Abercrombie & Fitch. Just pulled back a little bit, and my trend candles signaled too early. Like I said, sometimes it can get a bit jumpy if there's a little bit of volatility in the short term. But as long as that pullback stays under 35%, 40%, and the fundamentals are still good, we're still beating on earnings, just let it ride. That's how you do trend following. You got to try and capture those big trends. Get in at $30 a share, and you're still holding it at 170. This is an example of an outlier. Of course, not all trades will go this way. Another one of the best performing stocks, a small cap over the last couple of years, Alpha Metallurgical Resources, AMR. Again, you don't have to see all 5 indicators uptrending to get in, but ideally you want to see the majority of them. And again, make a judgment call of when to get out based on them all, the current market environment, and sometimes other things come into play as well. Like if your portfolio becomes too concentrated in a certain sector, that can also play into your decisions. So you always want to keep a balanced, diversified portfolio. But the main thing is to be mostly systematic and let your winners run for as much as they can while giving them some wiggle room. But remember, price momentum's number one. If the stock pulls back too much, regardless of the fundamentals, just get out, move on, put your money into something better. So if there's one thing I want you to take away from this video today, it is to don't mess with the outliers. I'm a bit of a purist when it comes to trend following. I still follow a lot of the old turtle traders from that experiment back in the early 1980s. Richard Dennis, very wealthy man from trend following, set up an experiment, hired a bunch of newbies, taught them his trend following rules, and some of them went on to be quite successful, running hedge funds and stuff. And even though they've pretty much given up on short-term trend following because of how markets have changed and algos and all that, a lot of them still practice medium long-term trend following, and they'll tell you, you got to give it wiggle room and don't mess with outliers. Let those profits run. Don't try and take half off after 50% or 100%. Don't tighten your stop or anything like that. You really just got to try and give every chance to capture those big trades, because running winners is the number one most important thing in trend following. And you'll find that a lot of trend following strategies, and this is what you can expect in my new stock pick service as well, is that about 50% of all trades will be closed at a small loss. About 45% of trades will be closed at a small win. And then approximately 5% or even less of all trades will be closed for large wins and responsible for more than 80% of all net profits. And that figure could be as high as 90%, even 100%, as the other 95% of trades could pretty much net off as break even, maybe slightly up or even slightly down. And it's these big outliers that'll make us most of our profits in the long term. And so in my opinion, knowing when to sell is more important than knowing when to buy. And for that, you've got to have a clear-cut strategy, because we have the luxury of choosing what to buy, but once we own something, we're forced with a decision of when to sell it. And no matter what strategy you're engaged in, trend following or not, you have to cut your losses and preserve capital. And the best way to do that is never own any downtrending assets, something trend following will keep you out of. Like I said, you've got to allow your winners to run, give them plenty of time and room, accept that you'll never sell at the top, you'll always give back some open profits. And importantly, stay diversified. Don't have too much concentration in your portfolio towards any sector, industry, or risk factor, because capturing outliers comes from making many bets and diversification. Not only will diversification lower your portfolio volatility and drawdown, but it'll also give you a better chance of capturing a big trade. Because if you only buy a handful, 5-10 stocks, pretty good chance there might not be a big outlier in there. However, like me with my stock pick service, I'm buying a new stock every week. That's 52 stocks a year. After 10 years, I would have bought 520 different stocks, or ETFs, REITs, or ADRs. The point is, it's a large sample size. I pretty much know for sure there's going to be some big outliers in there. And I just have to expose myself to that opportunity. At the same time, you don't want to fill your portfolio with stocks from one sector. For example, semiconductors, one of the strongest industries at the moment, and who knows, it could keep staying that way for another year or two. Nothing wrong with having a few bets there. However, if you filled your portfolio full of semiconductor stocks, and we got some external tail event like China going into Taiwan, and the whole semiconductor industry got cratered and went into a years-long bear market, well then not only will your portfolio take a bit of a drawdown, but you might have missed your chance of capturing an outlier from another industry that has nothing to do with chip stocks. So what you're looking at here is the backtest results for a trend following strategy. There's those fat tails that I was talking about. You can see there's actually more losing trades, losing 10, 20, 30%, than there are winning trades, 10, 20, 30%. So my new stock pick service is probably going to look something similar to this, where we're going to have that big fat right skew, large winning trades, and everything else in between will pretty much net off to break even. And like I said, trend following is quite messy and chaotic, especially in the short term. It'll feel almost like random results. Looking at a chart here of gambling versus investing. In the short term, it's difficult to distinguish between gambling and investing. Like I said, the dispersion of results in the short term will seem almost random. However, over the long term, if you're gambling, you will have a negative edge. It's almost guaranteed that you'll lose money. However, if you have a positive edge, sticking to good investing principles, cutting your losses, running your winners, staying diversified, not making any large mistakes, then you should come out in the green in the long term. And so I'd like to extend a big warm welcome to all my new Stock Picks members who've taken a chance and placed their faith in me. I really do appreciate that, and I take my commitment seriously, and I'm really determined to meet my objective of turning my brand new trading account into over $1 million US within 10 years. Hopefully a lot sooner with a good couple of years. I'm sharing all my trades out in the open. I'll be buying one new stock every Monday, and I'll be sharing with my members every Sunday what stock that is, sending out the pick before I make the trade. You'll get a detailed report in your inbox, understand why I'm buying the stock, and I'll be sharing with you my bullish thesis and justifications for the purchase. And I'll be making all my trades after I send the picks, along with screenshots of all my fills straight from my trading account, posted in the members area, where you can also see all the open picks inside the members area, along with account performance, updated weekly. You can see exactly what the latest account value is, along with total performance statistics. And I'll also send you a monthly portfolio performance report going over the previous month's portfolio buys and sells, performance, along with some insights and commentary on how the markets and portfolio is tracking. What you won't get with my stock pick service is sold a false stream of easy riches. I won't overload you with useless information. I won't give you 5 to 10 hours of work to do per week. You won't be following somebody who doesn't even trade. I won't be giving you any vague trading ideas or alerts after the fact, and I won't have a hidden or non-existent track record. Everything is 100% transparent. And so the most popular plan has been lifetime access, which is $770, and that's with no ongoing costs or fees, no sneaky upsells, nothing like that. And the good news is, for the next few days only, I'm offering 40% off as well. When you hit checkout, just click on apply coupon and type in stock 40. Click on apply and that'll knock 40% off, and you'll only pay $462 one-time fee, and that's to follow me on this entire 10-year journey. And like I said, I'll be doing my best to get there in under that time, and I'll be sharing all my ups and downs with you along the way. Nothing held back. We're bound to face a few bear markets, maybe a recession, who knows, maybe a market crash. We're going to be trading all the way through it, as I'm not going to stop until I grow my brand new trading account into $1 million US while sharing everything with you along the way. So if you'd like to jump on board with me and join the journey, then click the link below this video and head on over to my website, clickcapital.io, click on the red banner at the top, and your best bet is that lifetime access using the coupon code STOCK40 to save 40% off for the next few days only. Again, welcome to everybody who's already joined me. I'm super excited to get stuck right into this, and you have my word, I'll be doing my best to reach our outlined objectives. Thanks very much for sticking with Click Capital, and I hope to see you on the inside as well. Cheers.